bonds is tumbling as the market prices in further interest rate hikes. To break down what's happening in the bond market, I'm joined by Jarden board member Keane. Sean, thanks so much for joining us today.
Thanks,
Can you
Tracy.
please explain why bonds are losing value at the moment alongside shares?
Yeah, well, there's a lot going on, as you know, in the markets at the moment. There's a couple of key things. The first one is that the rate of inflation has picked up. So central banks, which have inflation mandates, are adjusting the cash rate so that they hit that mandate. And the second one, and this is something that's been emerging for some time now, is the end of unconventional monetary policy. So in 2008, in response to the GFC, we got very close to what we call the zero lower bound on interest rates, and central banks ran out of ammunition. They effectively ran out of rate cutting room. So what they started doing was buying assets. So they bought bonds, they made direct loans, they added liquidity to the system, and they created an environment where the demand for bonds exceeded supply. So bond rates fell. Now we're reversing that. So instead of being a buyer of bonds, the central banks are selling bonds. The other point I'd make is that whenever you get a change in a cycle, the bond market always leads. It leads the equity market. So if you look in New Zealand, our bond yield hit a low point last September at 0.45%. Today it's 4.5% we're going to. If you look at the equity market, we were still near the all-time highs in January of this year. So the two markets move out of sync sometimes. Bonds always lead.
And as the price of bonds fall, yields surge. How significant are the changes that you're seeing in bond yields at the moment, particularly those shorter dated yields that are a bit more sensitive to these changes?
Yeah, it's been, the moves have been extraordinarily fast. Markets are illiquid, and that's accentuating the size of the move. So sometimes when people interpret market pricing, they suggest that's what the central bank's going to do. In fact, it has something to do with market liquidity and positioning as well. So markets always go further than central banks. Now, having said that, the moves this year, the Bloomberg US government bond index is down 18%. It's the biggest loss in history in a series that goes back to 1973. So the moves are big. The other point is, if you look at the consequences of unconventional monetary policy, by the end of 2020, we had about $18.5 trillion with a T, dollars worth of negative yielding debt. Today, that number's back to just under $2 trillion. So the move in market yields has pulled all that negative yielding debt back towards zero. And that's a really good thing.
Now, I know that you mentioned earlier that bond markets lead equity markets, as you say, but
Yes.
Why do bond markets matter?
Well, the bond markets influence everything. So it's long been, through my career in bond markets, we always thought of the US 10-year bond yield as being the key asset price in the world. It influences every other asset price. When the bond market moves, every other market moves as well. The bond market's also the best gauge we have of inflation. So it's very sensitive to inflation changes, and it moves ahead of the central bank. The bond market's also the best indicator we have of credit stress. So if you're a bond investor, you're always looking at the credit risk you're taking against the issuer. So when markets get nervous about the quality of the borrower, they sell bonds. Bond yields go up. That's what we saw in 2008. As US yields go up at the moment, the ability of the United States to service its debt becomes more challenging. They'll do it, but it becomes harder for them to do it, and it becomes a bigger expenditure item. So the bond market reprices that change in borrower risk. It's key on that. The fourth thing about the bond market that's so key is the shape of the yield curve. Now, by that, I'm talking about short bonds versus long maturity bonds. And they trade at different yields. As the long end gets very close to short end yields or below, it's the best traditional predictor we have of recession. So bond market yields and bond curve shape are really important in terms of reading what's going on in the market. And the last thing I'd say is that bond markets, as I mentioned before, the 10-year rate is the most important rate in the world. When bond yields change, everything changes. So most other markets are priced as a spread to the US market in bonds, but all assets take bond rates into account when they're being calculated. So for equities in particular, the PE, the forward multiple that you're paying for, is heavily influenced by the discount factor you apply. And as bond rates go up, the forward cash flows are worth less. So that's why equity markets reprice.
Incredible stuff and plenty to watch. Thanks so much for joining us, Sean. Appreciate it.
You're welcome.